Lord have mercy. What am I doing with such a long YouTube video? Well, I don't know how long it's going to be because I haven't recorded it yet, but I have my handy dandy notes written on my clipboard here because I still do it old school and write them by hand, and there's a lot. So in order to get through this with a high content to time ratio, we're just going to have to dispense with the pleasantries and get going here. So in order to do what we're going to do, which is create an updating correlation matrix and an updating basis matrix, you're going to have to do some homework. So the first thing you're going to have to do is watch some tastytrade videos, just like the last one. You could, if you didn't do the last video, or you haven't yet, you need to go and watch 72414 market measure from tastytrade called beta weighted pairs trading. And that's going to be found on tastytrade.com. Go to the show archives, go to market measure, and find 72414 and watch that. And then you got to go back in time a little bit to 41014, April 10th. They did a market measure called pair up. And in that market measure, toward the middle end, they had a correlation grid, and it showed the highest correlated pairs of the ETFs that they were looking at. And we're going to some degree recreate that, but we're going to use an updating matrix that's going to give us the correlation every day. And then you can go and watch some videos from the guy Slim on tastytrade. He does a correlation bit I think every Thursday, maybe it's every other Thursday, but he did one on 9/26/13, and that was Russell 2K versus Dow Jones Industrial Average, and he talks about getting into the top weighted stocks in each index and looking for, relative strength and weakness in there, which I thought was pretty interesting and might actually spark another video. I don't know. And he also did one on 2/6/2014 that was about gold and silver, and he ties in the fundamental analysis of, or reasoning behind putting that pair on really nicely. He also gets into some technical indicators, which is not really my thing, but you should check that video out as well. You also need a way of getting stock data into Excel, and there's lots of ways to do that. The best ways to do it are using an API from your broker. TD has an API if you're an active trader, and IB's got an API. Basically, all the big ones have it. If you don't have that, or you don't want to set it up, because sometimes they can be pretty cumbersome, you can do what I'm going to do, which is get the data from Yahoo Finance. But I'll warn you that it's very slow, and as a result of that, if this video kind of seems to pause in random points, it's because something is bogged down or is calculating, and I don't want to have like long pauses in the video just waiting for Yahoo and Excel to communicate. The last thing you're going to have to do is get, actually two more things. You need historical data from the Spiders, Dow, Diamonds, the QQQ, the IWM's gold and silver back to 4/28/2006. And the reason is because that's the first day that the silver ETF started trading, and it seems like a good time to start to me. Maybe we'll get into that later. It gets the bull market, or at least part of it, and it gets the crash, and it gets the bull market we're in now. So go and get that data. We're not going to use the API to Yahoo to pull that data in because it's just too darn slow. And then the last thing you need is to put in your column headers. Just pause this video and put in all the pairs up here: Spider Diamond, Spider Q, Spider Russell, Spider Gold, Spider Silver, etc., etc. And you need them twice. So just put those in, copy and paste, unless you're like ultra masochistic and you want to type them again, but get them 2 times across the top, and then come on back when you're done with that. And assuming you've done so, let's come down to the bottom here, and let's get our column a little wider and find. So I'm recording this on 7/29/2014. So I'm going to grab this date right here. I'm going to right click, drag down a little bit, and let go. And if you don't know, now you know. You can hit fill weekdays, and you're going to get all the weekdays. You're also going to get holidays, so you don't have to go through those and delete them manually if they come up. And then we're going to come to this column right here, and we're going to use Yahoo. So we're going to equal get ticker data parentheses, and we need a ticker symbol, and our ticker symbol is in B $1, because it's always going to be in 1. And then we need a date, which is going to be in $A, because it's always going to be in A. And then the cell, which is 2077, and a comma, and then quote close, close quote, close parentheses, and enter. And that gives us that. And then we'll drag it across right here, and then we'll drag it down into the future, and we'll get nothing. Well, we will get nothing in a second when Yahoo realizes that the future hasn't happened yet, which is why we're calling it the future. So now I'm going to pause and come back when it's all disappeared. So you probably had a lag here too. I have all my trading stuff running in the background, which is not too smart. And I should just point this out right now that we need 3 sheets for this. So if you look on the bottom of my screen, I have sheet 1, and then I have correlation, and I have basis. And we're in the basis tab right now because we're using a long-term basis. So if you didn't do that, just make 3 sheets and put this data into the 3rd sheet. Take you 1 second. And now we need to come up to the top because we need to do all of our basis columns, and that is a little bit of a pain. I have mine filled in here already because it's kind of a drag because there's no way to copy it, but you just need to do it once and then it's over. So what we need here is we need an if error, because when we copy this down we have future dates that are going to fill in and they have formulas in them, and we'll get an error otherwise. So we need equals if error open parentheses, and then we need B2 divided by C2, so it's spiders divided by Dows, because this is our pair that's up here in H1. So you need this if error, and then you'll see if you just drag it across, there isn't really a way to you could use dollar signs to lock them down, but then when you pass through the spider pairs into the Dow pairs, you'll have to do it over again. So pause the video, fill these in, B2 divided by C2, and then come here and go B2 divided by D2, B2 divided by E2, and go through and put all that with your if errors, and come on back. And assuming you've done that, we will just drag all of these and double click down and get our basis, and if we scroll down you will see that we don't have any errors down at the bottom. So that's good, and that's going to be our basis data. And the next thing we have to do is we're just going to grab our date, SPY, Dow, Q, IWM, gold, and silver column headers, and head over to correlation and throw those in. Now for correlations we're going to use 60-day correlations, so we will use Yahoo for this because it's a little bit less. So like I said, if I had to pause, I'm going to do so. So I'm recording this at the very end of July in 2014, so wherever you are, you're going to want to back it up a few months. So I'm going to go 5/1/2014. I'm going to right click drag again, and I'm going to come down here. I need 60 days, so I'm going to go like 80 and go fill weekdays. And we're good. So now we need our SPY data starting here. So we need equals get ticker. Oh, come on, my hand batteries are dying. Okay, ticker data, and then we need open parentheses, $. I'm sorry, B $1, comma, $A2, comma, and we use close data. So I know what you're going to say, don't we use adjusted close? And we do use adjusted close, except that Yahoo doesn't make it easy. You can get it. They don't make it easy, I don't think, as far as I can tell, using this kind of formula to get it. So we're going to use closing data. And we're going to copy that down, and I might have to pause, so let's see. Yeah, I'm going to pause. Okay, we're back, and that took a little while. You can see we have some holidays, so we're just going to come through and take these out real quick so we don't get Yikes, errors. Okay, so this is our correlation page, 60-day correlation, and to do the correlations we need returns. So we have the spider returns. Oh boy, we're slow. Okay, the diamond. Okay, I'm gonna pause and fill these in because I got a little lag here. Okay, I have my columns in here to get returns. So we're gonna need another if error. So we're gonna do equals if error, and then we need actually another parentheses. We need spider today minus spider yesterday, and then divided by spider yesterday, and then we need a comma and two quotes because we want it to print nothing if there's an error, and we'll drag this across, and we may need another pause. I'm going to pause and copy this down. Okay, actually that didn't hang up for some reason, so that's good. So now now we have our returns. So we have returns and prices for the last 60 plus days in our correlation page, and in our basis page we have our long-term historical data and all of the basis for all of the pairs. So that's going to be that. Okay, so now we're going to make our correlation matrix. And to do our correlation matrix, we need to go into formulas, and we need to define a name. Okay, so we need to define a name. So to do that, we click on define name. Did you catch that? Define name up here. And in the name thing, we need to give it a name. So of course we're going to call it Tombat. Why? Because that's what we're calling it. You can call it whatever you want. And the Tombat, so basically what we're doing here is we're creating a named array that we can refer to that's going to pick up the last 30 returns, sorry, 60, the last 60 days returns, and then run a correlation off of that. So with our named array, we're going to get our correlations. So the formula is a little long, so stay with me. So the first thing we need to do is equal an index. Let me get that out of the way. Okay, and then in parentheses, and then we need our sheet name, and that's called correl correlation, ATION, exclamation point. Okay, and then we need the first column where our data is, and that's column H, because we're looking at the returns here. So column H. Then we need a comma, and then a match function. And the match function is going to use that old Excel trick of 9e plus 307 scientific notation. It's just a really big number. If you don't know what that is, just look it up. And then we need correlation, exclamation point again, and then we need $H and $H because we're in the same column. Then we need two close parentheses, and then a colon again, and then another index function. So index, and then we need correlation sheet again, and now we need our last column in our array, which is going to be M's. So we need $M, comma, and then another match function. So match, and we need a parentheses. We need our 9e plus 307 trick again, and then comma, correlation, exclamation point, because that's the sheet we're looking in, and then we need the $H. First column once again, close parentheses, and we have to subtract 61 days of data from that and hit close parentheses, and I'm having a feeling like it'll be a miracle if this works. And it did. So we now have a name of Tombat, and this is the formula that that indexes our array here of column H to column M for the returns of our ETFs. So we can close that up. And now we need to go to the first sheet, and we're going to make our matrix. So sheet 1, and we'll just come in here and we'll call it 60-day correlation, and we'll call it matrix because that's what it is, and we'll merge and center. And so from here, we need a little room. So from here, we just need our Dows, our Qs, our WMs, our gold, and our silver. And we need our spiders, and our Dows, and our QQQ, IWM, GLD, and SLV. Okay, now we're going to fill this in, and to do that it's going to be a little bit annoying like it was to do our basis, but we'll get through it. So here's how we start. We need a correlation formula, and we need it to refer to the index that we created. So we need equals CORREL, whoops, caps lock. Not that it mattered, but CORREL, and then we need index and another parentheses, and then we need our Tombat 0, 1, because we're doing the first one, and then we're correlating it to index Tombat 0, 2, and close it up. And so this gives us the correlation between the spiders and the Dows. Now, the issue with this is if you copy it down, you just get this same thing over and over again. So I will have to pause and fill this in, but let me tell you exactly how we're going to do this. This is 0, 1, 0, 2 for the correlation, which means that this one has to be 0, 1, 0, 3, and this one has to be 0, 1, 0, 4. And then when you come to this one, this has to be 2, 3 for the Dow Qs. So 2, 3, 2, 4, 2, 5, 2, 6. So I'm going to fill it in and I'll come back and explain it to you. Okay, so this is what we have, and you might have noticed if you filled yours in that you don't need that last silver ETF. So we have Tombat 01 and 02, 01, 03, 01, 04, and then we come over to the second column and we have 02, 03, 02, 04, 02, 05, and then we have 34, 35, 36, and then 45, 46, and then 5, 6. And this gives us our correlation this correlation, daily updated correlations for all the pairs. And you can just grab this and go to conditional formatting and go to highlight cells greater than, and I believe they use 0.75 for the correlation, and we will just go to, they use yellow. You think you're better than tastytrade? No, just use yellow, so we'll go to yellow and hit OK. And there you have it. So you can toss a border around here if you want to make it pretty. And that's our 60-day correlation matrix. So let's questions come to mind in doing this, but let's hold them till the end. And let's work on our standard deviation. So let's call this ST standard deviation basis matrix, because that's what it is. And we'll do the same thing here. So we need these things and we need these things, so we'll copy these, put them over here, and we'll fix that later. Okay, now to fill this in, we have to go back over to the basis sheet that we were using before, because now we need to fill in the rest of these arrays right here. So we need 3 we need three things. Hold on one second. Okay, we need three things. Sorry for the pause. We're running a little slow here. I have all my trading stuff open, so I probably should have closed that. But the first thing we need in this pair is we're just going to do our standard deviation for the column. So it's going to be equals STDEV and then the column H for the spider Dow pairing, and then we'll drag it across to gold and silver. So this is going to give us all of our standard deviations for the basis for the pairs. And the next thing we need is the average, so we have something to compare it against. So we'll hit average, and then we need the H column as well, and we'll copy that across. And then we need a lookup function, because we have to always have today's data in order to run the calculation, so that we can have this table update all the time. So there's several ways to do this, and in fact the entire thing can be done in one formula, but we might want to come back and make some amendments. So we're going to keep it in separate cells. So we're going to do equals lookup, and we'll use our 9.99e plus 307 trick again, and then we're going to hit a comma, and we need our column, so it's H in this case, so H colon H, and hit that and drag this across like that, and this is going to give us all of our daily basis. And the last thing we're going to need is the distance in standard deviations away from the long-term average basis. And in order to do that, we need an absolute value, because we don't care, at least at the moment, whether it's positive or negative. I don't think. We can always change it though. So we need the absolute value of today's basis minus the average basis, close parentheses, and divided by the number of standard deviations. So this will give us the number of standard deviations away from the average, and we can kind of check it in our heads by just looking at the average, which is 1.10, we'll call it, and the standard deviation, which is 1.14, and today we're at 1.16. So we should be at around 1.5, right? Because 1.5 times 0.04 is 0.06, plus 1.1 is 1.16, and that's what we get, plus the remainder here. So, I'm sorry, we're at 1.10 plus the standard deviation, so we're at 1.44. I don't know if that was clear. Let me try that one more time. You have the average, and then you have today, and we're about a little over 1 standard deviations away, right? And so if we look, and in fact we are a little over 1 standard deviation. We're actually 1.44, and the standard deviation is 0.04. So we're 1.44 standard deviations away from the average. So we just need to drag this across as well. And then we have to come back to sheet 1, because we're going to fill in our basis. And in order to do that, we just need to equals that formula that we just put in the absolute value one. So SPY Dow, so this one is just going to be equals, and then we just come back over here and we grab that SPY Dow and hit enter, and I'm going to pause and come back. Alright, we're back. So I've filled it in. So all I did was just hit equals and then come to the basis sheet. So we'll pick one randomly. Let's look at Q's to gold. So we just come over here to the basis sheet and we find Q's to gold, and it's 2.17, and it's 2.17 here. So that's it. We just filled it in. And every day when the data populates, it's going to change the basis for us. So That's it as far as the calculations are concerned here. This is going to show us when things are, multiple standard deviations away from the mean, so it makes it a little bit easier to identify. And the reason why we need both of these is because if you look at the Qs to the silver to silver, we're 2.55 standard deviations away, which is way, way, way outside. But if we come over here and look, there's no correlation there. So for my money, there's no trade right there because there's really no relationship. So it's not reliable to say we're 2.55 standard deviations away from what, if there's no relationship. So that's why we need to look at both of these. Now, for starters, I don't think this is really ready for you to throw together and start, necessarily trading real money on. And the reason is because as I was putting this together, I realized that a lot of questions come up, and the questions revolve around optimization because, right now we have a basis that runs back to 2006, and there's markets move. And I don't know if 2006, 8 years worth of data is just too much data, and we need to be looking at shorter term, or if it's not enough data. It'd be hard to believe it's not enough data, but maybe it isn't. The other thing is, the relationship between basis and correlation. How do these two things move? Are they both mean reverting? What's the optimum correlation to look at? What's the optimum deviation to look at, and the relationship, between the two of those? You know, we could look at the internal correlations of the names inside the indexes, and we could back test. I think you'd have to use probably R or MATLAB. I don't think you could do it in Excel, but you could back test the the pairs trades that you put on, looking at points where we're many standard deviations away from the mean basis. You could do a chart here in Excel, and you could sort of manually go back and look at where we were well off, and how much you would have made or lost having put those trades on. But I think we're at 30 minutes almost, and I think we've done a lot. And maybe we've given the guys over at tastytrade something to think about. I don't know, or maybe not. Maybe this is just a cool little widget to have put together, and we could expand on it and put tons more ETFs or even underlyings on here, and have it update every day, and just sort of open it up every day after the close when Yahoo puts their data out, and identify underlyings and that are stretched, and look at trades for that. So once again, the credit for this almost entirely goes to the tastytrade guys. They put all this stuff together that sort of got my brain working, and motivated me to put this together. So hopefully this is useful to you, or you can adapt it to your own needs. Thank you for watching. Any questions, comments, criticisms, things you see that I did wrong, things I could do better or faster, anything like that, throw it in the comments section. I'm always learning every day, and I enjoy doing so. So thank you very much. Bye.